Assalamu alaikum. We are going to talk about the practice question GPE, the latest past paper, September-December 2024 and 25 means it is relevant to the 2025 as well. So the requirement is here for the GPE project, calculate the expected net present value, comment on its financial acceptability. Now, here is the scenario in front of us. So expected net present value we need to calculate. G company is a company which manufactures car batteries. It last project in a new battery called G Power XL, which is a variation on an existing battery but uses less harmful material in its construction. Due to technological advances, the GPE project is expected to have a life of only 4 years. Sales for the first year are expected to be 10,000 units, but the remaining 3 years, they are more uncertain due to risk of similar products being launched by competitors. G company expects that sales volume will remain constant at 10,000 per unit for the final 3 years, but there is probability that volume could drop to only 5,000 units per year for year 2, 3, and 4. 30% probability that volume will drop. So it means 70% probability is that it will remain 10,000. Okay. The GPE has a selling price in current price terms of this $70, but the sale price, inflation is expected to be this. The variable cost per unit is this, and inflation is expected to be this. Fixed costs remain constant, $10,000 per year. Manufacturing equipment cost $500,000 will be purchased at the start of the first year of production. The equipment will qualify for tax allowable depreciation at 25% reducing balance basis. It is anticipated that it will have zero residual value at the end of year 4. Working capital 80,000 will be required at the start of the first year of productions, and its inflation is expected to be 3% per year. The working capital needs to be in the place at start of year to which it relates and will be released at the end of the project. G company pays corporation tax at a rate of 20% and tax is paid at the end of year to which it relates. G company is profitable and can utilize any unutilized tax allowable depreciation. Okay, can utilize unused tax allowable depreciation. Okay. G company uses a nominal after-tax cost of capital of 13% for appraising project of this nature. So now every information is available to us. So I normally recommend my students that we should start such questions with the working, because a lot of working has to be done in such question. So starting with the working, the first working will be that of the units. Okay, so that is the year 1, 2, 3, and 4. So number of units will be, in the first year, they say 10,000 units are expected. And then afterwards, there is 30% probability that they could drop to 5,000. So 30% probability that they will drop to 5,000. Plus, it means 70% probability is they will be 10,000. So this is basically expected value we are calculating. So 8,500 from year 2 onward. And here it is. How we calculated it? Once again, that they say that there is 30% chance that unit sale will be 5,000. So what about the remaining 70%? It will remain the same. So 30% into 5,000 plus 70% into 10,000. And this will be the unit sale. So selling price per unit. So they say that selling price per unit is expected to be $70 per unit. And its inflation is 4.5% per year. So in the current price terms. So if we have to inflate it at the rate of 4.5%. 4.5%. So you see here 70 into 1.045 raised to power 1. We have linked it with the number of year. So life will become easy now. So it will be automatically inflated for 1 year and we'll simply drag it. So this will be the selling price for the upcoming years, inflated selling price. And then sales we can calculate. So working 1, that will be the sales. So selling price per unit into number of units. And here we can drag it again. So sales have been calculated. Then is the variable cost per unit inflated at the rate of, what is the rate? 3%. So variable cost per unit is 45 into 1.03 raised to power number of year. Like this, variable cost per unit. So total variable cost, that is the working 2. So we will multiply per unit variable cost into 10,000. And simple is here. So this is total variable cost of the units. Then is they have given us that the fixed cost will remain the same. Any other working? Yes, we have to calculate tax saving on capital allowance. So working 3, tax saving on capital allowance we need to calculate. And how to calculate? So from here, year 1, year 2, year 3, and year 4. So written down value at the start of year 1 of the equipment is 500,000. 500,000 is the written down value. And then they say 25% is the capital allowance, return tax allowable depreciation. That is 25%. And tax is at the end of same year. So same year it is. So this into 25% capital allowance. The next year written down value will be here. Previous year written down value less capital allowance charged. So this will be the written down value at the start of next year. Now capital allowance will be this into 25%. So what will be the written down value next year? Written down value last year less capital allowance charged last year. So this will be the capital written down value. Now capital allowance, this into 25%. Now the next year written down value same will be repeated. Written down value last year less capital allowance charged. And the last year they say the scrap value is 0. So the whole this minus 0 scrap value will be charged here. So this is the capital allowance. Now we can calculate tax saving on capital allowance. That is 20% in the same year. So capital allowance into 20%. That is the tax saving on capital allowance. We have calculated now. The next is any other working? Yes, we have working capital. So the working number 4, working capital. So working capital year 1, 2, 3, and 4, year 0. They say that working capital will be required at the start of first year. So working capital level, they say it is 800,000 will be here. At the start of the 80,000, sorry. Yes. And then it will grow by 3% per year. So equal to this into 1.03. And like this. So incremental working capital. Incremental working capital, that will be equal to minus this initial outflow, incremental working capital. Then total working capital required is this. There is already this available. 80,000 is already there. Required is 82,400. So the difference between that will be additional outflow. You see here, 80,000 is already outflow in year 0. 82,400 total required in year 1. So the difference will be the additional outflow. Now, simply, here we are. So total outflow so far is 87,418. That will be the inflow in the final year, incremental working capital. So we have done all the workings. Now we will proceed towards solving the question. So year 0, 1, 2, 3, and 4. So first of all, that will be the sales. So sale working is here. Simple is that. We have linked the cells and here we go. Less variable cost. So negative sign, since it is variable cost, total variable cost is here. So variable cost is here. Link the cells. And then is fixed cost. Incremental fixed cost, $10,000 per year. Okay? $10,000 per year. That is negative 10,000. And here we are. Remain constant. Now, so here is the taxable cash flows. So taxable cash flows, sum of all these. Taxable cash flows. And now less tax, 20% same year. Negative 20% since it is payment. Into this. And here we go. That is 20% tax payment. Now, tax saving on capital allowance. So we can put the tax saving on capital allowance here, which we have calculated below. Then is the working capital. Working capital, it will start from year 0. We will link the cell. Then is initial investment and scrap value. Scrap value is already 0. So initial investment is 500,000. Now, students, here will be the net cash flows of the project. Net cash flows of the project are here in front of you. And present value at the rate of, what is the rate? 13%, which is the cost of capital. So, future value into 1.13 raised to power minus n. You know the formula, future value is equal to present value into 1 plus r raised to power minus n. So this is how it is, present value is calculated. So NPV, net present value, sum from here to here. So this is the NPV of the expected NPV. This is expected NPV because we have taken expected number of units sale. So comment on the financial acceptability. So the NPV of project is positive. So it will lead to the shareholders' wealth increase. So it should be accepted. But there is a point. But it is based on expected unit sale of 8,500 from year 2 onwards. There is 30% chance that sale of unit may be 5,000. And if that happens, NPV of the project may become negative, not making project not viable. So this is how you have to discuss it. Normally students say NPV is positive, so it should be accepted and done. But here there is some additional thing to be commented. 2 marks are here for comment. Second part of the question is here. Let us proceed towards second part. Discuss 4 techniques for dealing with risk and uncertainty in investment appraisal. They said discuss, not list. So 4 techniques only, 2 marks each. So discussion means you have to discuss it in depth. Try to link with the scenario where possible. So for example, sensitivity analysis is there. Sensitivity analysis is one technique. The second technique can be expected values or probability analysis. Then the third technique can be simulation model. And the fourth can be, that is, risk adjusted discount rate. So we have to discuss 4 only. There can be adjusted payback as well. Now, the point is how to discuss one by one. So discuss. So sensitivity analysis measures the responsiveness of NPV of a project towards a change in certain variable. That is how much a variable should change to make NPV of project 0. Here, in this case, NPV is affected by sales, selling price, variable cost, etc. So which one is critical variable? Sensitivity analysis helps us to identify that where a small change in a variable can make NPV 0. But it has a drawback. It has a drawback too, that it considers each variable one by one on, while all it does not considers the impact of all variables at once. That is the drawback as well. So enough for 2 marks. We have given some scenario reference as well, and one drawback as well discussed. So that will be enough for it. So expected value is basically weighted average. It is the weighted average outcome of all possible possible options. Weighted average. Okay, it just like that, 30% chance in this scenario that units will sale will be 5,000, and 70% chance that it will be 10,000 as from year 2. So expected value gave us 8,500, a weighted average of both values. So it incorporated the risk and gave a single amount. But it has a drawback, that weighted average amount may actually occur only when a project is repeated many times and majority of projects are one-off. So that is the expected value 2 marks discussion. Now simulation. So simulation model considers all variables at a time and the possible change in them along with their effect on the NPV. Now, so it is computerized model basically, and is quite sophisticated and has wider applications, but it is costly, time consuming, and still relies on probabilities, estimations. So this is the point, another point. And the last point is risk adjusted discount rate. Now, so the NPVs of the project are calculated using discount rates on cash flows of the project. Higher the risk of project, higher will be the discount rates. How are the discount rates? And project specific discount rates are also calculated to cater the specific business risk of a project, of the project. Capital asset pricing model considers the same, that higher the risk of the company, its projects, higher will be the discount rates to be used for its compensation to investor. So that's enough. So 2 marks each point 2 marks. So 8 marks, it is done. Majority students do mistakes. They do not discuss to the point. They may start doing 1 point excessively discussion for 1 point, and the second point they might not be discussing it properly. So 2 marks each point, remember. So 2 valid points in depth discussion is required. Thank you.